Hi, everyone. My name is Mike Zlatnik, also known as the Big Mike. I'm CEO and founder of Temple Family of Funds and Syndications, and I'm joined here by Mikhail Pritzker, also known as Misha. He's our Director of Asset Management. Misha, thanks for joining.
No, thanks for the invitation, Mike. Good morning, everybody.
And today we're going to talk about relative value of various asset classes in today's environment. And we are recording this in late March 2025. Of course, things will change in the future, but this is relevant to what's going on the market in the world today. So without further ado, we will proceed. Wonderful disclaimer. This is for informational educational purposes only. No advice of any kind, no solicitation of any kind. If you're interested in any of our funds of syndications, request PPM to accredited investors only. Always consult with your attorney and CPA professional before making any investment decisions. We have a great webinar coming up. We have industry leaders. It's going to be a great panel with some of the brightest minds in commercial real estate today. So we'll have folks that you can see on the right. The webinar is it's a live 2-hour webinar on April 11th. As you can see here, the wonderful group of folks, and I hope you have the opportunity to join us. On the next slide, you will see how to register. Here's the way to register. Please scan this QR code and take the opportunity to register for this webinar. It will be one of the best things you've done in a long time. If you're bored, you got nothing else to listen to, here's a wonderful podcast with a cheesy name, Big Mike Fund Podcast. If you got nothing better to do, tune in by going to bigmikefund.com. And if you misspell it, forget the D at the end. Just go to bigmikefund.com. I promise it's not a kinky site. Please subscribe to our YouTube channel. This and many other wonderful videos are posted on the channel. We try to make it interesting, exciting, educational, and I hope you click like, subscribe, and comment. Thank you.
Yeah, thank you, Mike, for all those beautiful announcements. Quick question. Why do we want to talk today about the relative value? Why do you think that is important right now?
Well, we're all students of Warren Buffett. And if you're not, it's a good time to join Warren Buffett Club. He's always been about value investing, about finding a great deal today. Most of us are naturally looking for a great value today, great deal. We all want to get into a great deal. And relative value is all about the discussion, what's expensive today on a relative basis versus what is a great value on a relative basis.
Thank you. A few words on where we are right now. In what environment are we talking right now?
Sure. I think picture is worth 1,000 words. US in 2024 has done phenomenally well. The dollar has led the world relative to pretty much all major other currencies. And what else to say? We had great 2024. And 2025 started a little bit rocky, but we're still the greatest power in the world. We have the reserve currency, and we are leading the world, and many other folks are following.
Yes. A few words on GDP, maybe, because that's a very, very well-known metric.
Numbers speak. 2024, US GDP outpaced the world. Many other countries have done okay. We have done relatively better. Although I'll add one more comment. We are starting 2025 with a projection of decelerating GDP growth. And that's acceptable. That's normal. Us slowing down probably will mean the rest of the world will slow down even more. We'll see. But last year we were the leader.
Of course.
So a couple of words about inflation, interest rates, unemployment, etc. So it's a complex graph, but the long story short, we obviously saw post-COVID spike in inflation, driven by the obviously broken supply chain, monetary policy. Fiscal policy, the government spent a lot of money, and the monetary policy responded with the fast and furious interest rate hikes. That's what the blue graph is. Interest rates spiked very, very fast. It has continued to cool inflation, but the interest rates have stayed higher for longer. The Fed started cutting interest rates in the fall of last year, and then they stopped, and they're in the holding pattern to see what will happen with the inflation, unemployment, GDP under the new administration, which is normal to see who is the new sheriff in town. And the new administration is preaching a lot of change, and they're changing a lot of things at the same time. So the Fed chair and the FOMC just need time to see. It's a wait-and-see stance until these new policies, fiscal, regulatory, trade, immigration, all shake in, and the impact will be known. So we are in the wait-and-see pattern for now. That's where we find ourselves today.
Let me say a few words here just to support what you were just saying. I'm going to talk about several asset classes that people normally perceive as a part of their portfolio, and we've heard a lot of conversations about Bitcoin. Yet Bitcoin is a great asset in somebody's opinion. You see how volatile is that right now. And we don't have any fundamental backup for the price of the asset. That's why it probably goes up and down, up and down. It's shown a significant growth since 2020, but look at the volatility. So we always got to be very careful when we think about something is growing. It's growing, but it's also had a time when it went significantly down, and we have to account for that. Gold, for example, gold had a great run in 2024, and it does have the fundamental value behind it. It's been used in many manufacturing processes, and in general, all this perceived as a shelter. Yeah, so it showed a significant growth, but you never know if it's going to perform in 2025 that much because there is also a limit to that. So, do you want to hold everything in gold or Bitcoin? No, it also should be a blend of things like that. Uh, Getting back to the major metric that people are using right now, which is S&P 500, it also shown a significant growth since 2023, I would say. Yeah, with ups and downs, but still, look at the values. Yeah, numbers talk. From 3,600 to 5,600 recently. I think we updated it a couple days ago. But many people say that it's overheated. So getting back to the relative measurements, Mike, how can we state if it's overheated or not? What would be your take on that based on next slide?
Sure. So I'll comment very, very quickly on a couple of things you pointed out. In the last couple of years, we saw a rapid growth in many assets. It was everything rally: crypto, precious metals, stocks. And there's a concept of reversion to the mean. Sometimes hot rally can overheat, and the market forces bring those things down. And that's what we saw exactly in the recent volatility in crypto and stocks, S&P 500. Now, precious metals continue to be less volatile. They've seen a strong run driven by some other forces, market forces, but there's a real demand for gold. Now, if we look at S&P 500, price to earning ratio, one of the most basic and the most profound ratios in understanding are the stocks cheap or are they expensive? And if you look on the historic basis, we were in the 80s, we were in the low teens, let's just call it, and we continue to climb into the 90s, into the mid-teens. At some point, we overshot, went into the 40s, and then collapsed again into the mid-teens. Then we had 2008 boom and bust, and again the valuations, the S&P 500 ratio, sort of settled in the mid to high teens, and then we continued to run up, and then we had a pre-COVID fast and furious run, and then S&P 500 fell quite a bit in the post-COVID world as a result of the COVID situation. But the march up is still pretty strong in the post-COVID world. And we're now at the S&P 500 P ratio over 30. That ratio is in the danger zone. It's almost inevitable sooner or later that ratio will fall down. And the reason it does is that investors come to their senses and realize that they are overpaying for their earnings. For the dollar of earnings, they're overpaying because of the investor sentiment. When the sentiment changes, the prices fall. And there's only two ways how PE can come down. It's either prices fall or the earnings rise really, really fast. So when the earnings continue to rise way ahead of the normal times, then you could see PE getting into the stratosphere. So investors are buying future growth. And when the growth slows down, then they realize they have overpaid for these assets, and then they dump those stocks fast to exit before somebody else sells before them. That's why S&P 500 at 30 is historically in the danger zone. It's almost inevitable after S&P 500 reaches this level that it's got to get down into, let's call them, at least low 20s, maybe even in the high teens.
Maybe you can, talk a little more about the components of S&P 500 growth, the dividends and the earnings per se. So this is the slide on dividends.
Sure, the dividend yield is essentially at almost historic low on a long term, if you're looking at the last 40 plus years. So yield, income in S&P 500 is very low. You can't generate any income or very low income through these S&P 500 stocks. That's the problem. Investors who need to get distributions, need to get income. They're not just relying on the appreciation. When the appreciation story slows down, people start looking at the dividend. And when the dividend yield is this low, guess what? People start selling stocks because the dividends growth is a function of the earnings growth. And when the earnings growth slows down and dividends become unaffordable, then the prices appear to be way too high. The prices have outpaced the ability to pay dividends in a manner of speaking.
And about earnings a little bit.
Sure. So we've seen strong earnings growth in the last few years, partially driven by a lot of injection through the fiscal policy. Lots of money was transferred hands from the government coffers, or even no such thing as government coffers. It was printed, literally created into the system. The cash was injected in the form of PPP loans, all kinds of other help. And all those injections of cash essentially helped companies sustain earnings. Now we're dealing with the government going through Doge, through the government shrinkage. It is very possible that the earnings will slow down. Again, is it sustainable? I don't know. But there's substantial uncertainty related to the fact that the government is turning more fiscally responsible and is not going to throw a ton of additional dollars into circulation supporting these earnings. And that will slow down GDP, slow down earnings, and most likely bring questions to investors. Are they paying the right price for those stocks with a current PE of 30? That PE of 30, what we saw in a previous slide, was a danger zone, and it was only supported by rapid earnings growth. Once the earning growth slows down or comes down, guess what? Investors make appropriate decisions.
Yeah, thank you so much. Let me just draw a line over here, kind of summarizing what we were just discussing. So there has been a great rally in the major asset classes that we've seen for the last 5 years, I would say. Yeah, and those were Bitcoin, gold, S&P 500. But any of them has their own disadvantages, like super volatile or unpredictable, or backed up by something that would never happen again in the future, like governmental spendings or helicopter money, and so on. So, but now let's maybe switch to the next asset class where we perceive to be professionals at, and that's the real estate. Let me give you a brief overview of what we see right now, so that then we can basically kind of combine all the knowledge together. So here's the map of the United States, and we put a circle around the area where we believe the majority of growth is happening right now. So all the Sunbelt states experienced a significant cooling. Would it be rental growth? Would it be occupancy? Would it be prices and so on? They were overheated dramatically. So you see that the rent growth is negative over there. Midwest is a steady Ada region where we see very stable rent growth for, I would say, the last 29 years, I would say, because it's backed up by labor. People live there, work there, and they have a very strong affordability ratio, meaning that they're paying about 25% of their median household income per year to their rental expenses. If you look at the next slide, that's a summary of different areas, different cities in the United States, different markets. And you see the Sunbelt states and all, that goes together with that significant experience, a significant negative growth change. Yeah, would it be Austin, Denver, Phoenix, San Antonio, and so on. But look at some Midwest, for example, areas that I highlighted with green, like Detroit, Cleveland, Columbus, St. Louis. They're all in a positive zone, and some of them are leaders, actually, like Detroit, for example. Yeah, that means that the geography of income in the United States is changing a little bit, and we got to be very, very careful in how we choose and what we choose. In general, speaking about national vacancy rates, check it out. I mean, you see that the United States and B classes are actually very close to the normal 7% vacancy rate. 4-5 star classes, which means like A plus things, are struggling a little bit, still at 9% vacancy rates. But the trend is that they'll go down as well. So we're in a healthy market. But in a way, look at what's going on right now with the deliverables and demolitions. For the last years, we've seen a lot of permits. Now it's a gap. People didn't apply for new permits for the last several years. And you see a significant drop in deliverables over here, which is caused by lack of new permits. So it's lack of new deliverables. Look at 25, 26, 27. Yeah, it's hardly recovered from what we've seen like earlier before. And that would basically create the supply wave that you're going to see on this slide. So you see the supply, would it be top 10 markets or bottom 10 markets? All the supply is going down because, I mean, people didn't intend to build anything. And that would create some sort of deficit of a new places where people would move in. And we know that we have a shortage of housing in the United States. But on the other hand, check out the demand pattern, which you see is like annual demand trailing 4 quarters is significantly growing right now. So what we're going to see is that there's going to be like a gap basically between supply and demand, while supply is shrinking and demand is growing. And that would give an upward pressure to the real estate per se and rental rates and so on. That's the environment where we are in the geography and the market per se. Mike, maybe you can lead us a little bit in a conversation about cap rate spread. What is that and where we are right now in terms of this particular metric?
Sure. So everything you just talked about the commercial real estate, specifically example of multifamily, is actually trading at a substantial discount to where it was a few years ago. When the interest rates were very, very low, the prices of commercial real estate were at the peak. And when the interest rates rose, the valuations have come down. So we actually find ourselves now at the bottom of the market. The great value is in the commercial real estate assets, including multifamily and many other strategies within the commercial real estate. Why? Because it depends very much on the level of interest rates. And interest rates were very low if you go back and look at 2020, 2021, before the hikes in the interest rates. There was a positive spread between the market cap rate, so capitalization rate or cap rate, is what is one of the most important metrics of values of the properties. The higher the cap rates, the lower the prices. The lower the cap rates, the higher the prices. So what we saw during the period of low interest rate environment, we saw the cap rates being very, very low because the interest rates were very low. So here's an example of our cap rates falling all the way to 21, even 22, before the Fed started hiking interest rates. The cap rates were very, very low. That's the blue graph. And then the cost of money, or the interest rates, were below the cap rates. So people had a positive spread. In other words, the price they pay per dollar of income. That's what cap rate symbolizes. If you buy $5 worth of income and you're paying $100 for that property, that's a cap rate of 5%. It doesn't account for cost of debt service. It just simply explains how the asset is valued relative to its net operating income. So the cap rates for many of multifamily assets were in the sixes, they fell into the fives, mid fives. And then the Fed started to hike interest rates, and that's the red graph. So they started hiking in March of 22, and then they hiked through most of 22. So through 22, the cost of capital, the mortgage rates, grew fast and furious. And then they outpaced the cap rates, essentially creating a negative spread. So if you wanted to buy a property, you would pay for it a price such that the more mortgage you add, the worse is your cash flow, because your cost of mortgage, the interest rate, was higher than the cap rate that you paid. And 23, it got even worse. The spread widened in the negative direction. And the spread is still negative in 2024. But what's really interesting and fascinating is that if you can find a motivated owner, motivated seller, and get a great deal from them and buy a property with a positive spread because of a distress of the owner, that creates a great situation. So the goal of value investors is to buy a property with a strong positive spread. We'll cover that in a couple of slides, but this is what this graph means, that the cap rates have stayed negative because the interest rates have stayed high, and the prices really didn't retreat enough to account for the massive move in the interest rates. Today, we find ourselves with some distressed opportunities. As a result of these higher for longer interest rates, distress levels in the commercial real estate industry have increased. So depending on which asset class you look, obviously office has not done well because of the COVID effects. But if you look at multifamily, distress level has grown. Even self-storage shows some growth in distress. And what it does, it creates opportunity. It's not a volume game, it's a precision game. Certain owners exhibit more distress, and that's the time they can be approached when they have to sell, and a great bargains trade in this environment. And next, we're going to see what a great deal looks like today.
Yeah, thank you, Mike. Absolutely. Again, so we just gave a little overview where the market is right now. And this is basically why we believe that it's a great time to buy multifamily. Because
and by the way, another commercial real estate investments that can be bought today at a great positive spread. But we're using multifamily as an example.
Yes, 100%, 100%. And by the way, we also help investors to deploy their funds in retail, let's say, at some point, and that also behaves in some locations fairly well. But getting back to multifamily, it's highly discounted, as Mike mentioned. Rates, anyway, we expect them to fall. That would boost the valuation and decrease the pressure to cash flows of the properties. The loans are becoming favorable a little more and more. We see that the market of single-family houses is overvalued, meaning it's way more easier to people to rent right now, and financially it's less burden than to get a mortgage and to buy something. And we see that monthly expense of buying a home now surpasses like by 50% of renting. As a result, many individuals are renting more versus buying. Yeah, and as Mike mentioned, the U.S. economy is strong, and hopefully will skip the recession and keep on moving forward. So it's a good time to buy. But Mike, what is a great deal today? What are the components of a great deal today?
Sure, I just wanted to use it as an example. So in commercial real estate today, if you can get a deal with 2% spread between the cap rate that you pay and the cost of mortgage. So as an example, we did a deal called Waverly on the Lake, and we bought it at a cap rate of 9% on multifamily with the cost of money, the mortgage rate is 7%. That's a 2% spread. If you can do that, you're in a phenomenal shape. That creates a massive margin of safety. So the price you pay per door or per dollar of income is very important. And today, the opportunities are absolutely at the historically, generationally great level. So buying a positive spread today is a possibility with motivated sellers. Furthermore, you could buy well below reconstruction cost, even 50% below reconstruction cost. It's such an insane time to buy existing if you can get a good deal versus building. Many people are talking about building. Building, you could make money, of course, The challenge is it costs to build what it costs to build, but you can't get a discount on construction. Whatever it's going to cost to build, that's what it's going to cost to build. But on existing, if you find a motivated seller, you can get a phenomenal deal. Obviously, strong positive cash flow from day one. That's essentially what that 2% positive spread guarantees. It creates a spread. The more leverage you add, the stronger is the cash flow per dollar of equity. Furthermore, if you can structure a deal with strong bonus depreciation, there's even more power to this type of a deal. We expect that bonus depreciation will get renewed. Trump has mentioned it as one of his goals to extend 2017 make permanent tax cuts, and bonus depreciation is part of that package. Obviously, working with a great operator and sponsor with strong track record and ability to execute strong capacity. When you're looking to invest into anything, you always think of who before how or who before what. Who you're investing with is the number one consideration, and then you look at what deal or deals or fund you're investing into. Next, of course, in real estate, location, location, location. So if you can invest in a great market, real estate maintains the value and grows the value in a great location. So it's very, very important to pick strong, sustainable growth markets with good demographics, good economics, a location where people want to live, people want to work and enjoy their life. And then large other incentives in the form of special tax treatment, tax abatements, other tax benefits. Can you get special utility company reimbursements related to the improvements, capital expenditures that convert old, inefficient, energy inefficient components of the project into high energy, very efficient systems that can be rebated? Most of the cost of improvement can be rebated through the utility company policies and available programs.
Yeah, and by the way, Mike just mentioned Waverly and the Lake deal, so you can find the video where we review the deal on our YouTube channel as well. We'll probably put a link underneath that video as well, over there, so you can check it out. But Waverly was exactly as a sample, beautiful deal that we just executed. So, Mike, a few words about our fund, maybe Tempo Income Fund, just just an observation where we are right now.
So we just completed a webinar on Tempo Income Fund. Actually, it was live yesterday, and it will be available on our YouTube channel. So tune into a webinar now in recording that talks about Tempo Income Fund. It's our flagship income fund. It's been around since mid-2021. Here you see the historic returns, and its target return 10 to 13% annually. It distributes on quarterly basis. Folks can reinvest distributions. We use third-party fund administration, third-party audit, and a conservative income-focused investment strategy. If you're interested in the fund, request PPM to accredited investors only. Of course, always talk with your CPA and attorney professional. And this webinar took place yesterday, so we are recording this a little bit past that recording. You could guess based on this slide that we're recording it on March 21st, and the webinar was on March 20th. So if you get a chance, please watch the webinar. We had a great crowd, great questions. Hope you take the opportunity to tune in and take a look. And Tempo Income Fund is that fund that invests in real estate, and it is mostly focused on debt investments and lending, but it does have a portfolio of income-oriented equity investments too. Again, to learn more, tune into that webinar.
Great. Thank you, Mike, so much. So what are the conclusions of that conversation? We spoke about relative value. We spoke about multiple assets that people perceive active and attractive these days. We spoke about the general situation in the real estate market, precisely using multifamily as an example of commercial real estate. We talked about what is the good deal, what is the bad deal, why is it a good time to buy, and we gave a brief understanding of what Tempo Income Fund is right now. So just draw the line, few words. What are the conclusions?
So on a relative basis today, most of the commercial real estate asset classes look incredibly attractive relative to many other asset classes, in our opinion. Of course, we don't know what the future holds. It's very possible that other asset classes could outperform commercial real estate in the long run or not. But in the short run, commercial real estate values have come down quite a bit from the peak of 21 and 22, and they appear to be incredibly attractive based on the capitalization rates, based on the cost per door basis or cost per reconstruction cost. So on a relative basis, you can get into deep value buy today on commercial real estate deals. And if you look at the stocks, crypto, even precious metals, I don't know where they go from here. All we saw recently is pretty substantial volatility in the heavily appreciated asset classes, crypto, S&P 500, and other indexes, stocks in general. So it gives folks an opportunity to think about broader diversification. Another thing that really happened in the last couple of years, folks have enjoyed a great ride in stocks and crypto, and their portfolios are overvalued and overweight in those investments. Is this the right time to diversify into what appears to be a lot more attractive, such as commercial real estate? That's the question, and let folks draw their own conclusion. We believe the opportunities in some of these commercial real estate strategies are a lot more attractive, but let let every person be the judge of their own observations.
100%, 100%, 100%. Well, if you need to contact us, here is the QR code. You can follow us on pretty much any social network, including LinkedIn, YouTube, Facebook, and so on. Scan a QR code to schedule a call with us. And here we are. It's been Mike Zlotnik and Mikhail Pritzker, Misha, also known as. Thank you so much for your time, Mike. Thank you.
Thank you all for tuning in. I appreciate you very much. Until the next time. Thank you.
Yeah. See you guys. Thank you.